Okay, so I'm going to do the overview and deal with our strategy. David will do the property portfolio, Andrew the financial results, and I'll deal with the prospects. So yeah, I think our results were pleasing. Didn't shoot the lights out, but we did a little better than we thought and what we originally budgeted. So swings and roundabouts as usual, and Andrew will take you through those. It was a busy year. We started with the Fountainhead acquisition, the Growth Point involvement, getting in my business, but we sorted that out. And as you probably saw last week, we now have 62% of Fountainhead. We'll worry about the other 38% in due course. When we get some breathing space, we'll look at it and decide what, if anything, we want to do. We've had significant further progress on our restructuring, which you recall we started just over 2 years ago. This year we spent 1.3 billion, the bulk of that 1.1 on the 50% share in East Rand Mall. But during the year and agreement reached subsequent to year end, we've bought a further 6 properties for a total value of 3.4 billion. And that's of course subject to the usual regulatory conditions, Comcom and the usual, so those will come through over a period of time. We have a development pipeline of 3 billion underway, predominantly 90 Greyston, 90 Rivonia and Motlasana Mall. We became a REIT from the 1st of September, and we established the first property company, ADR, subsequent to year end. On Redefine International, we made significant progress. The inward listing happened on Monday, and by December, hopefully, we'll be a UK REIT and have internalized the management company. And our brand awareness has become entrenched. Redefine is becoming more than just a company. We're becoming a brand, and we have more and more recognition. So I think as much as we tease Mareka, well done, and I think some of the money was well spent, not all of it, but some of it. So our investment proposition, again, I think most of you know what it is, not going to spend too much time, but we've got attractive real yields, capital appreciation, high visibility of our earnings. We've got a better than a good qualified, I think it's becoming an excellent quality, diversified portfolio. Very limited spec development, internationally diversified, so we get Rand hedge, which for the first time in 3 or 4 years actually came through at the right time for these results with the depreciation of the Rand. I said to Andrew earlier, we can't put this on the balance sheet. I don't know why IFRS doesn't take into account, but our management team and our staff are really our greatest asset. So to all of them, I say a big, big thank you for helping us with these results. I really think that our depth of management, and even right across the line, we've got staff who want to work for Redefine and who are committed, and they really are our greatest asset. And recurring fee income has become a part of our business as opposed to the non-recurring, and that's where we are with that. So our growth and capital appreciation prospects, 2013, as I said, we acquired 50% of East Rand Mall, another few small ones, and the 3.4 billion, which David will go through, is exciting. Our priorities in 2014 is to dispose of the government tenant office portfolio. All going well, that should be listed hopefully in the first quarter. That will substantially complete our realization of our property portfolio. Obviously, we'll continue to acquire good quality properties if and when we find them. And in the portfolio of our size, there will always be some churn and some properties that no longer meet the criteria, but it'll be relatively small, and that will be recycling of capital. So we'll have an ongoing restructure, but without a dilution in earnings. I think where we've come over the last 2.5 years, you'll recall when we started this journey, we said we had managed the dilution to sort of 1 cent, 1.5 cents a year. This year it was about 0.5 cent. We sold 360 odd million of properties at 10.8, reinvested at 7.2, so that was about 13 million rand, which is roughly 0.5 cent. So 7.3% growth, including that dilution, I think was pretty good. You all probably know that there's now a new BEE scorecard that we need to comply with, and we'll be taking steps to do that also in the new year. because it's becoming more and more important when we negotiate major deals with tenants. Our focused property management, we expanded our leasing capacity, we improved our customer relations, we internalized the recovery of electricity charges, and that's had a major impact. That's only been going for 6 or 7 months. You'll see it in Andrew's presentation. That's made a big difference to us. We've got a specialist management focus on retail, given our increasing focus on retail, and that's working very well. And the Fountainhead property management is being taken on and should be complete by 1st of December. For 2014, big focus on improving management information, although it's pretty good. We're going to continue the refinement of processes, focus on costs of service through leveraging economies of scale. That's between our portfolio and Fountainhead. We've already seen some significant savings on simple things like insurance when we use both, and we'll continue doing that. We're going to introduce technology-based applications. Now, I'm not quite sure what all this means. David can explain it, but I'm told we're going to get a lot better doing things because we're going to use iPads and iPods and stuff. So I think it means I can't shout down the passage. I have to phone people. I'm not quite sure, but they'll explain it to me. And we're also going to introduce that into our shopping centres. So we're also going to be a pure property play in terms of local. The Fountainhead transaction has seen our stake in Hyprop dilute to about 12 million units or 5%. That'll be sold in the next couple of months, if not sooner. And we will then be left only with our international holdings, which are currently held through asset swap, and even that may become a little bit more simplified. But certainly from a local point of view, we will no longer be a hybrid. And that's where we are at that. So our management of debt, I think we've had a good year without going through all of the individual items. Big thanks to Andrew. Our debt has reduced from 8.9% to 8% at year end. He says he has a challenge to hold it at that level next year, given where the curve is and swaps. But I've told him it's got to come down a couple of bips. So he's shaking his head. But even if it's only 20 bips, Andrew, we can get there, I'm sure. So that's really what we want to do. And obviously improve our loan-to-value ratio. That will happen automatically from the sale of the Hyprops and the sale of the government portfolio, because that takes out 2 billion of asset and 2 billion of debt. So that by this time next year, 34-35% LTV is what we will be looking for. I know some of our bankers are here tonight, so we're also looking for a little bit of relief from them from the excessive charges. So please take note, all of you. I see you sitting around. And we also want to increase the level of unsecured debt. That's because our Moody's rating is something that they put emphasis on. So we'll be trying to do that. And of course, restructure expensive debt. In the international markets, as I say, Redefine, the refinancing is completed, the structure has been simplified. We are looking to increase our presence in Australia, but not necessarily through a direct or an investment in Cromwell through the headstock, through the fund. They're now trading on about a 7.5%, 7.6% forward yield. So we finally have a South African Reserve Bank approved structure, which will allow us to invest directly in offshore property. And if Cromwell find a suitable property for us, that to partner them on a 50-50 basis, where we can get an 8.5% yield with gearing at 50% at 5.25, it should give us a return in excess of 10, and we can fund that through leveraging our Cromwell units. We've got about $200 million in Cromwell units. If we get 75 or $80 million off that, it could add 25-30 million rand to the bottom line first year. So if we can find the right asset, it's something we'll certainly be looking to do. Something which we've done successfully in the past, I don't think we always get credit for it because people ask us, is adding value to our existing properties. So besides our current development pipeline of new stuff, we have about, Mike, correct me, I think about 600 million, 600 million of being spent on existing properties to add value. We've done a lot of those in the year that have been done. So we'll continue to look for and identify those that we can add value to improve and get better yields. And we've also providing redevelopment services to Fountainhead. The Fountainhead board has approved about 640 million of value add to 3 centres, and we should be starting that early in the new calendar year. So that's my little story from there. David will now take you through some of the more important detail.
Afternoon, everybody. What I'm going to do is I'm going to give you some stats initially on the portfolio. I'm going to talk to you about leasing activity during the year. I'm going to go through what's happening in the property management division. I'm going to talk about acquisitions and disposals, a bit about development, and then I'm going to give you a scenario, essentially a scenario or position as at August, and then 2 scenarios thereafter. Firstly, the portfolio at the moment, the value is approximately 24 billion rand, 251 properties, not much different from last year. Total GLA of 3.1 million. Seems that whatever we do in terms of acquisitions and disposals, we always end up at around 3 million square meters of space. What's new this year is that retail for the first time is about 40% of the portfolio. Previously, I think offices is approximately 41. Previously, offices was closer to 50%. There's a significant change. 65% of the portfolio is in Gauteng, which I think has been the case for a while. The top 20 properties make up 35% of the portfolio by value. 31% of the portfolio is single tenanted, and the top 20 tenants contributes 46% of the monthly rental, with government contributing 16% of that and 32% of the office rental. And A-grade tenants contribute 63% of the gross monthly rent. Okay, insofar as leasing is concerned, we talk about the lease expiry profile first. For the first time, we find ourselves in a position where our lease expiry profile, we have less than 20% by GLA of leases coming up for renewal every year. Going forward, we're not going to be in a position where we have 800,000 or 900,000 square meters of space to let, thankfully. So going forward, the monthly leases are, I think, as most people know, essentially the outstanding government lease agreements, which makes up the 8% of monthly space. The 2014 profile looks like about 8 to 9% of the portfolio by GLA that will come up for renewal. Just going on to tenant retention. As Mark indicated, we have a division that concentrates purely on the retention of tenants. From a national retailer perspective, we meet with their property division quarterly and look at renewals, what's happening in their industry going forward, what's happening with our developments, etc., etc. We've also started a process where Mark and I and Antoinette Coetzee, our retail analyst, go to see the executive of the various national retailers, essentially to try and understand their strategy at board level so that we can try and align ourselves with what their intentions are. Just in terms of renewal growth for the year, overall the renewal reversion was 6%, with average escalations going forward of 8%. Offices and industrial were 5%, and retail 8%. Now retail 8% essentially off the back of particularly good renewals on national retailers during the course of the year. Tenant vacancies. Vacancy is now down to 5.3%. Offices remains at 8.6%. Retail at 3.8% and industrial at 3.7%, but that's the lowest that we've had, I think at any point in time. Okay, property management. Retail skills. We have employed a number of retail skilled people to look at the portfolio. Obviously, as the bias moves towards the retail sector, we've significantly bulked up those skills. Tenant relationships, as I indicated before, we have a tenant retention program in place, and the focus is purely on tenant relationships throughout the portfolio. cleaning and security. Essentially, cleaning and security for Redefine and Fountainhead amounts to about 150 million rand a year. And one of the things we're looking to do is to see whether we can either put a business together or partner with an existing business or businesses and look at how we can save costs. It's our gut feel that there's between 10 and 20% potential savings if it's managed in the way that we believe it should be. There are rebates, for example, from CETA when it comes to training of personnel. Of course, in our industry, one never sees the benefit of that. So it's that type of angle that we're looking at. We believe in the next, certainly the 2015 year, we're looking for a 20 million saving for both businesses. Non-GLA income. Again, we've partnered with a company called Go Metis, who are experts looking at what is generally referred to as non-GLA income. So what they do is they look at media and advertising, digital, non-GLA areas such as kiosks, etc., sponsorships and parking. And the idea is so that we can maximize potential income from those areas. Electricity management. Redefine's holistic approach to energy savings includes the elimination of energy waste, implementation of energy efficiency initiatives, and the responsible introduction of renewable energy projects in an effort to optimize operating costs and reduce its environmental footprint. We've established a specialist in-house utilities management division, which will focus on the effective recovery of cost. The initial focus will be to upgrade efficient lighting across the portfolio. And whereas we've done this sort of thing in the past, it's been done perhaps on a fragmented basis, and we're now going to be focused through this division to take advantage of these areas. We're going to be installing occupancy sensors and timers and installation of variable speed drives for HVAC systems. The effort so far will show a 7.4 million rand saving for this financial year, where we expect that to be increased significantly. Electricity recoveries have been insourced, and a full recovery is expected during the 2014 year. In addition, we've commissioned the installation of a solar power plant at Park Meadows in Johannesburg, and are investigating the possibility of a similar installation at Matlasana Mall, being developed out in the Matlasana district. Technology, this is Mark's favorite. We're in discussion with various service providers to install open access fiber to properties where appropriate. That'll allow tenants access to high-speed data services at lower costs and various other benefits that come with that. We're installing Wi-Fi in various shopping centers and certain of the office blocks. And then we're going to be creating shopping center-specific apps for smartphones and tablets. And that'll provide general shopper information, location-specific comparative advertising, shopper movement, location of parking, et cetera, et cetera. So you'll be driving to a shopping center, you want to know where you can park, you can pick that up on the app. You could be in a shopping center looking to buy a pair of jeans at Edcon, and if Markham's decided, for example, that they wanted to advertise over the app, you could be standing at Edcon and looking at comparable prices at other stores in the center. And there's that type of thing that we're looking to do. Okay, moving on to development. The competitive tender market continues to weaken as contractor order books fill. Commercial building costs are expected to rise by approximately 7.5% this year, which will place upward pressure, obviously, on required rentals to achieve acceptable development returns. A specific focus of ours over the last 2 to 3 years has been the upgrade of properties within the portfolio. Current projects have an approved value of 619 million at an average yield of 9%. And some of the portfolio activity sorry, I'll come back to that, is in Gauteng, it's 190 Barbara Road in Isando, Premier Milling in Waterloo and Pretoria, in KwaZulu-Natal, Scottsville Mall, Essex Gardens and South Coast Mall. Interestingly, that, as you know, South Coast Mall, we acquired the other 50% from Hyprop during the course of last year. What we've managed to do is to agree with Food Lovers Market to come into the center. We're negotiating with Discom, and various others. And I think for the first time, we'll probably be able to introduce a fashion element. Just again, as an example, Essex Gardens was a B-grade office park. We've managed to convert 2 of the properties into A-grade. We've built a further property. We've added a parking deck, and we're working through the park essentially to convert to A-grade property. What we've managed to do is increase average rentals from about 85 Rand gross up to as much as 130. And then, commitment to new development, as Mark was saying earlier, with an approved value of 2.5 billion at an average yield of 8%, is presently in progress. I can just talk to you about those developments. 90 Grayston, I'm sure that those of you who drive through Sainton have seen it's out of the ground. I think it's now 4 or 5 stories out of the ground. Progressing well. We're on the short list for an international company to take up 50% of the property. We'll know mid-November where we stand. And then there are various other negotiations taking place. We didn't think that interest would come about much before the last quarter of this year, and in fact, I've only arranged the initial broker launch for about 2 or 3 weeks' time, because we didn't think that there was any point in doing it sort of June, July, because we wouldn't get the interest that we were looking for. 90 Rivonia Road, I think you know, we're building approximately 35,000 square meters. 25 is for Weber Wenzel. It was a lengthy process that we went to win that project. In fact, I think that what set us aside there is the fact that we were able to get finance at much cheaper rates than what most of our competitors were able to. But again, I think that there's about 9,000 square meters here that will be let to alternate tenants, with Weber Wenzel's having right of first refusal to take up the space. We believe that they'll probably take up most of that before anybody else moves in. 190 Barbara Road is a warehouse that we're developing in Isando. This is a property we're doing on spec. It's about 16,000 square meters, 14,800 of warehousing and 1,200 of offices. A lot of interest. The building will be completed in mid-2014. We're quite confident that it'll be let before that. As you know, warehousing has really been the name of the game with industrial over the last couple of years, and it's particularly well located in Isando. Essex Gardens is the property I talked about a short while ago, the office block. And then Standard Bank Centre, I think you know, we're putting on new facades, we're adding parking decks. It'll have just less than 4 bays per 100. I think is the highest parking ratio of any property on the foreshore in Cape Town. The major tenant will be Standard Bank. That deal has been done. They'll occupy about 20,000 square meters. The other tenants in the building are Telkom and the City of Cape Town Municipality. And then Matlasana Mall, again, due for opening October 2014. It's going particularly well. We're well let, I think well over 75%, mainly to nationals. We're comfortable that we'll be 100% let early in the new year. And again, it's a 1 billion rand project, initial yield at 8.25%. Okay, then if I can move on to acquisitions and disposals. The activity to August. Acquisitions for the period amounted to 1.3 billion at an average commencing yield of 7.2%. Significant property, as Mark indicated, was the East Rand Mall. Disposals amounted to 366 million, average yield of 10.8, essentially 12 properties in CBDs around the country, and in line with our strategy of moving away from this aged property. Post-August, Redefine has concluded agreements, subject obviously to the usual approvals, for the acquisition of properties for a total consideration of 3.4 billion, an initial yield of approximately 8%. Disposed of 5 properties for a total amount of 216 million at an average yield of 10.8%. Okay. The sectoral spread, what this essentially does is it sets out the position at August, the properties that we've acquired post-August, and the position then, and then if we take Fountainhead, the 62% as a see-through basis, what that value would convert to if we were looking at our portfolio, and then what happens once the developments that we're involved in are completed. So if you look at up until August, there'll be about 24 billion rands worth of property. And then afterwards, we've acquired that list. I can start with Maponya Mall. We were fortunate enough to be able to partner Dr. Maponya going forward. We went through a closed tender process. We were fortunate that Mark and I went to meet with Dr. Maponya. And what we'd like to do, if you wouldn't mind, is to come up and maybe say a couple of words.
Mr. Makwena, ladies and gentlemen, thank you very much for this opportunity of just having a few words with you. I must say this, that this day is the most exciting day for me, for having to come here to cement the relationship with Redefine. This day, to me, is like the day when Dr. Nelson Mandela cut the ribbon for Maponya Mall. First time when he cut the ribbon and declaring it open. It was the most exciting day for me. I would have liked to take you through my journey, but because of time constraint, I'm not going to do that. I will only make few remarks because I know we all are tired. We've been working very hard for the day, and we want to retire in time to go and have a rest because tomorrow is still a working day. First of all, I would like to thank my previous partners, Zenprop, for having been very bold and bullish when things were very, very difficult indeed, when Soweto was still red-lined as one of the most dangerous places to be in. My journey was a 27 years journey when I had the dream of wanting to put up a mall for the people of Soweto. And when I had this dream, everybody did not believe that I was actually dreaming. They said to me, it looks like you're now beginning to be mad because nobody believed that a mall of the standard and the size of Maponya Mall would actually ever been built in a place like Soweto. And nobody believed that a mall of that size and that standard would be a successful mall as it is today. As you may all well know that last year, Maponya Mall was voted #1 in Gauteng, and nationally we were voted #2. Very, very, very close #2. I want to thank Zenprop for having very bullish, particularly Jonathan Bear, who was a great gentleman when all the banks promised me that they were keen to support me, but they just could never get into a decision to give me the money. I went to Investec, and Investec were very, very keen, and they said to me, this project looks to be very, very interesting indeed, and we would like to get involved in it. But when we look at your balance sheet, we believe that it is not strong enough. We want to introduce you to a company that can join hands with you so that you may realize your dreams. And then they introduced me to one of the company. When we spoke with them, we realized that they were only going to go with me until the project is bankable. And when it's bankable, they are going to get out. Then I said, I wouldn't like to get in bed with an organization that is going to sell so early. Then I looked around and I was introduced to Zenprop. We had a meeting with Zenprop, 2 meetings. The meeting broke, and I was walking away, angry. As I got into my car, driving away, Mr. Jonathan Bear came running and he said, "Will you please stop?" And I stopped the car, and he said to me, "You must be very disappointed indeed." I said, "Not only disappointed, but I'm very angry that you guys wasted my time. I was talking to other people, and I believe that I could have made a deal with other people." He said, come back, please, let's talk. When I went back, we started engaging, and he said to me, "Look, I am going to take over the chairmanship of this meeting. On Monday, I'm going to lock the room. Nobody's going to go out of that room until we get a decision." And indeed, when that Monday came, Mr. Bear was the chairman of the meeting, and in that meeting, that is when we concluded the deal, and he took a telephone and conducted a gentleman of the CEO of Investec. He was in London. We made an appointment for Wednesday. Come Wednesday, a meeting. A deal was struck within a week thereafter. We got money. It was a bit of expensive money, but nevertheless, it really triggered the deal because those days things were very, very difficult. It was during apartheid time when nobody would ever believe that a black person can be given money that can build a mall the size of Maponya Mall. Fortunately, I got into bed with a very good gentleman who understood where I wanted to go. When we started talking, I said to them, I don't want to build a warehouse. I want to build a mall that can stand anywhere in the world. Then I told them, the architect about the mall that I saw in London. Then when I said that, he said, I know the mall. I actually can make a mall better than that one. And indeed, we sat down and it was a draft after a draft until we arrived at putting up the mall, Maponya, it is now. It's an exciting mall. It's a mall that has been welcomed by the people, not only by the people of Soweto, but by the entire South African people. That mall is a mall that everybody who is black is proud of. And I'm very excited today to have the relationship with an organization like such as Redefine, because I know you are specialists in the field. I know in terms of your records that you are going to be wonderful friends, wonderful partners. Mark, thank you very much for visiting me. The day you visited me at my house, I knew that we were going to make a deal. We had quite a number of gentlemen who were coming in and out wanting to partner with me. But after having had a discussion with Mark, and I knew that this is my lifetime partner. And thank you very much for having visited me, because had you not do that, maybe I wouldn't have known you, and I wouldn't have made a decision to partner Redefine. Ladies and gentlemen, I am looking forward for a brighter future, and I am really looking forward for us growing the mall to its capacity, because at the present moment it's showing a wonderful growth, but I believe it can do much better than it's doing right now. And I believe it will, in fact, do better with Redefine management. Thank you so much indeed.
Thank you very much indeed. Thanks, Edwin. Thank you. Okay, going back to the properties that we've acquired since August. Next one is the Discovery property, previously owned by SICOM. We bought it in partnership with Zemprop. The intention, once Discovery move out, is to redevelop it. Design Quarter in Nickel Grove, which we acquired some time ago, but there have been certain town planning issues which have needed to be sorted out. That now looks like it's going to happen shortly. We acquired the Ericsson's building in Woodmead that you see on the highway as you travel through to Pretoria. Ellerines in Cato Ridge, which is a large distribution center, and 50% of the new Alexander Forbes property in Sandton. So if you take that, you take off the government portfolio of about 2.2 billion, and you look at the donut in the middle, essentially what that shows you is our retail portfolio then starts to look at 43%, and offices reduces to 37%. If one then looks at the Fountainhead investment and the developments, 90 Grayston and 90 Rivonia and Matlosana, and you look at essentially the shape of the portfolio once that's happened, we'll have a 33-odd billion rand portfolio with 50% of the portfolio invested in the retail sector. Okay, then just a brief overview. The top 10 properties by value at 31 August, I think you're all aware of. I think what that shows is that East Rand Mall is obviously the most expensive, and for the first time, Golden Walk has been knocked off the perch. Going forward, and looking at the scenario that I discussed earlier, that's the nature of the top 10 properties. It'll be about 9 billion rands worth of in value, and predominantly retail. And then I just have some sector comments, if you like. This is not intended as a macroeconomic discussion. It's just a couple of comments that we have discussed around the office. The first one is that nationals will continue to take up space. Various brands have indicated that they'll take up between 3 and 10%. There is a growing presence of international brands, and that will create opportunities for certain new developments, expansions, and competition for existing centres. Although relatively unknown brands will battle to find prime premises, There are a number of brands that are relatively unknown coming into the country, and it's our opinion that they will battle to find space within the larger regional centres, and that they're not going to differentiate one centre from another. The cost of occupancy ratios will continue to rise, and as pressures on consumers, for example, toll roads, will place pressure on rentals, particularly the line shops. Will Pick n Pay's move to a central distribution allow landlords to convert low rental storage space into higher level retail space? I'm not sure. It's something that we're looking at. It might not be that easy to convert, but possibilities. Are certain retailers expanding too quickly? I'm going to mention the names, but there are certain retailers, in our opinion, who are necessary certainly for new developments and for many existing. Our concern is logistics and whether they have the capacity to expand at the rate that they are. Non-prime, high rent yielding space may come to the market as banks look to reduce their footprint. Essentially, we know what's happened is the banks tend to take non-prime space in centres. They pay high rentals. There's no question that they're looking to reduce their footprint across the board, and what's going to happen with that high-yielding rented space. The longevity of content-driven categories, cinemas, books, music, etc. It's our opinion that the days of cinemas being a draw in most shopping centres are over. We've met with New Metro and Stir, and it's interesting that they're quite happy that for most of the year they have 15 people at any cinema showing. Their business model is based around what they call blockbusters. Now, that's all well and good for them, and that may be profitable for them, but it doesn't support fast food or food outlets that are essentially set up around cinema. So that we think is going to be a problem coming this year. And then just a question, what future furniture stores in certain centres? Then going into offices, just some comments really about Sandton. Premium and A-grade space has been the best performing segments during the year. However, we're concerned there'll be a further increase in vacancy levels across all sectors. New development is on the rise, mainly tenant-driven, with fierce competition for corporate tenants. And the name of the game is really musical chairs. There are no new tenants coming into the marketplace. There are tenants moving. The professional companies are expanding, and that's pretty much it. If you look at large pockets of space that people are vacating for Ernst & Young, for example, Weber Wenzel, they're leaving pockets of space in what would previously have been seen as A-grade space. That space is not going to be let easily. It's going to place pressure on A-grade rentals, and we see that as a distinct problem coming forward. The major development activity is really Sandton-driven and driven by the relocation of corporates, and remains the strongest office node in the country. Our speculative development at 90 Grayson is shortlisted by an international company, as I mentioned earlier, as the building is now more visible. If you go back 3-4 years, the Redefine investment in Sandton was probably about 100 million. Once all the developments have been completed, it'll be 3.4 billion rand. And typically, to get an 8% initial yield on a premium grade office building in Sandton with delivery late 2015, you're going to need rentals approximating 200 rand a square metre gross. And then just a couple of points on industrial. Vacancies are reduced to 2008 levels. There remains a shortage of premium warehousing, particularly with good transport linkages, greater stacking heights and small office components. This demand has obviously been influenced by logistic companies, international and local retailers. Redefine's industrial exposure is 5 billion, with 80% being warehousing and high-grade or high-tech property. The majority of our 38,000 square meters of vacant space in the industrial sector is light manufacturing and standard units. It's 26,000 square meters. It's our intention to continue selling the obsolete industrial properties, and we have acquired a large tract of land in an area called Cornubia, which is north of Mhlanga, which will allow us to develop industrial space of approximately 85,000 square meters. Thanks very much.
Good evening, everybody, and to those in Cape Town. Before I start, I just wanted to mention that whenever we get ahead of ourselves, Mark is very quick to remind us that there are only 3 things that we can do to make our business successful. The first one being astute asset management. The reason for that is the right investment choices result in securing long-term leases at market-related rentals, and that in turn translates into capital appreciation over the long term. The second is tight cost control, and the third is prudent management of funding. I hope after the conclusion of my section here, you'll be able to confirm that Redefine has ticked every box and some for the new financial year. Turning on to our 2013 financial highlights, we're very pleased to announce that the results are ahead of market guidance. Our distribution growth is 7.3%, and we had a very good second half, up 7.7%, and part of it was due to the rand depreciating to some extent against the pound, and that assisted us to give a little bit extra to what we promised the market. Our distributable income for the year exceeds 2 billion rand, which is quite a substantial number, and in rand terms, our distribution has grown by 15.5%. Our balance sheet, which I'll show you in a short while, has been transformed and has been strengthened as a result of the inclusion of Fountainhead in this financial year and the exclusion of Redefine International, which is now equity accounted, which was consolidated in the previous year. When we get to the NAV slide, you'll see a very pleasing outcome. We're up 69.3 cents to just under 8.71 rand, which in itself is a great achievement. And then I think we must go back to our active portfolios margin. You'll see a pleasing increase there, up to just under 78%. Our average cost of debt, as you heard from Mark, is 8% on average for the year. That's a reduction of 90 basis points on debt in excess of 14 billion rand. You can imagine it's quite a sizable saving for us. But going forward, there is some task, given that the swap curves have become unkind to us, principally driven by the threats of quantitative easing coming in. The market has overreacted in our view, but it hasn't come back to a level which we think offers good value if you're fixing over the long term. Our equity is up 1.7 billion rand. That was as a result of issuing shares for cash for 800 million, and 900 million rand was in respect of the Fountainhead acquisition that we did earlier on in the financial year. Our total tangible assets are 44 billion rand, and our debt capital market presence continues. We currently are sitting on about 2 billion rand of bonds, and 1.5 billion rand was raised in this financial year. Just looking at our corporate structure, you'll see it has become simplified. We're looking all the time to make it more understandable and easier for the analysts to model. You'll see that Redefine International now is treated as a direct holding, given that on Monday, Redefine International PLC was inwardly listed, and Fountainhead Property Trust now is consolidated, given that we control it on a number of different levels, not just on a straight legal interpretation, but also from an accounting interpretation. And last but not least, you'll see that the Cromwell Property Group, through Redefine International and ourselves, as a unit, we hold about 26% in Cromwell. Just looking then at our distributable income, as Mark said earlier, our non-recurring fee income is still there, hasn't disappeared, and it won't, but it's become less of a feature in our numbers. We don't see any reliance on that anymore, and that speaks to the solid base from which we operate. If you look at the split of the first and the second half, you'll see the growth I spoke of earlier. Just looking then at the contributors to the 68.7 cents, you'll see that about 70% of our distribution comes from Redefine on a standalone basis. That is stripping out the contributions from our listed securities. Now, within the Redefine number is funding costs, and also I've spread the additional units in issue across all the numbers. So if I attribute the extra units that we issued during the year to the various assets or listed assets that we acquired, being Fountainhead principally and Cromwell to some extent, and also the funding costs that we incurred to support Redefine International in terms of their rights issue, that Redefine's contribution grows to about 75%. Our listed securities on a combined basis is just under 21 cents of that 68.7 cents. And that's a number just to keep in the back of your minds, because later on I'll talk about that a bit more. This slide isn't here to confuse people. It's here for the academics or the accountants. We always ask the question about our distributable income. How does it talk back to our IFRS income statement? The truth of the matter is the two don't talk to each other. We have to do quite an extensive and confusing reconciliation. And this will be Redefine's last distribution as a property loan stock. So this will be the last debenture interest distribution, which essentially is our income that we distribute. Non-capital income, I should say. Whereas as a REIT, as you know, it's more of a tax-driven nature. And this reconciliation will feature quite prominently going forward to demonstrate to the public at large that we're not distributing capital to make up shortfalls in expectations. If there are any questions later on, please don't hesitate to ask me or Leslie, my colleague, who's more than able to explain what's happening. Just looking then at the drivers of the growth in distributable income, you'll see that 194 million rand of the growth came from the net operating income from our investment properties, by far the largest contributor. Listed securities has grown. That's principally due to the acquisition of Fountainhead. Fee income, that's now recurring. All of that growth is from the Fountainhead Management Company that we acquired. You'll see there that administrative costs have increased. Some of it is due to the extra marketing awareness that we've created out there. It's been in for a full year this year as opposed to a partial period last year. But in addition to that, there are extra costs that we have incurred in providing support to the Fountainhead Property Trust. And there is fee income sitting against that, well, rather the fee income sitting in the top line. So we could net the two off, but for transparency, we've separated the two. Share of distributable income from associates, as you can see, has declined. That's not that we've lost that revenue, it's just gone elsewhere. That 19 million has actually gone to listed securities income. That was Cromwell, which is no longer regarded as an associate because of the deconsolidation of Redefine International. It's now treated as a listed security. And then you'll see finance charges are up 78 million rand, a big number, but bear in mind our debt has grown by about 2 billion rand. So if you factor that in, it's by no means a substantial increase given the extra debt on our balance sheet. Redefine International, as you can see, is 50 million rand up on its position last year. Once again, a big chunk of it came from the pound, and probably in even measures, there was also an improvement from the underlying business given the equity or the rights issue that they did early on in the financial year. Just looking at a simplified distributable income statement, this essentially for us is how we look at our business, which is probably the simplest way to do it, and that is to take our operating income from our investment properties, which I'll go into a lot more detail, and then add on all the other bits and pieces. For example, Fountainhead, we treat it here as a listed security, whereas in our books, you'll see that they're consolidated. So it gets very, very confusing. On this basis, it's much easier to model, and I would urge people rather to do it on this basis, because if you try and get into the numbers with contractual rental income and costs and so forth, it's going to probably give you a lot of trouble in terms of accuracy. Listed securities, 322 million. As you can see, it's slightly down. That's mainly due to Hyprop that we've used as currency to acquire Fountainhead units. I spoke about our fee income already. Our property trading income, that's another feature of Redefine that's it's basically in extinction, if you like. It was one of our strategies, was to get out of speculative trading, and as you can see, it's becoming a non-entity within the numbers. Administrative costs I've spoken about, and I think if you want more information, you can look at the published results. It's available on the web. It's also in your booklet. We also split the numbers out between Fountainhead, ourselves, and International in a lot more detail. Looking then at the active portfolio. Our active portfolio, the way in which we categorize it is that it's properties that have been owned in both periods for 12 months. So it's a like-for-like comparison. As you can see, We've grown our active portfolio revenue by 7.2%, and that's principally off holding costs essentially flat. I'll go into a lot more detail on those costs. As you can see, that is a pretty good achievement, given a lot of cost pressures out there in terms of administered costs being electricity and rates and taxes. Our active portfolio revenue has grown just under 6%. I'll also speak a lot about that in a short while. And the balance of the growth, taking the 7.2% on the active portfolio up to 10% overall, is mainly due to properties that we've acquired that are coming on stream now and weren't in the prior periods. A pleasing feature is the margin. As you can see, 78%. It's 1% ahead of the prior position. And once again, I've got a slide there to show you exactly how we were able to achieve that. Looking then at the revenue, you'll see that a very difficult time has been experienced on the letting front. Overall, you'll see that new lets have provided us with 84 million rand of extra income. However, we lost 86 million rand through vacancies. Now, we were very lucky in that we have a diversified portfolio, and this is a perfect illustration thereof, because if you look, you'll see that our industrial portfolio had quite a big knock. We had 2 properties that went vacant during the course of the year, causing quite a big or substantial shortfall in revenue, 36 million, and we were only able to cover it to the extent of 22 million rand. That deficit was made up by retail, which you can see did very well. We had new lets of 37 million rand as opposed to vacancies of 24. Offices held their own in this difficult market, despite the churn that's going on. So year on year, you see the growth at the bottom there. Industrials had a tough year, but retails had a fabulous year, growing just under 10%. Overall, as I said, just under 6%. If you just look at the expenditure, you'll see that on the second line, electricity charges have gone down by 3/4. The reason for that is through the internalization of electricity charges, as well as a number of electricity savings initiatives that we've adopted on our buildings. There's been a concerted effort on municipal charges. You can see that in our recoveries on our municipal charges. They've gone from about 68% to 72% over the period. And all the other costs, as you can see, we've tried to contain as best we can. Property management has gone up quite substantially, but that is a deliberate strategy to improve our property management capacity, especially in the retail area, an area where we were probably a little bit shallow historically, but now are beefing it up to take on these new properties that we are acquiring. The other costs are generally in line with activity. Bad debts, as you can see, is basically in line with last year, but that was mainly due to a substantial write-off in the prior period. Just to look at the trading efficiency, you can see that for every 100 rand of property revenue, how much falls to the bottom line and where the consumers are. But before I go there, if you look at the property margin from 2010 through to the current year, you'll see that on average, we've been able to improve our margin by about 1 percentage point per annum. Now, that's going to become quite difficult as we go along. We're not going to have the benefits of initiatives such as the internalization of electricity beyond 2014. So we're going to be hard pushed to maintain these margins from 2015 onwards. But as you can see, for now, we have done very well. The big decrease or the big push in decreasing our property margin, apart from the electricity savings that we've engineered, is on the management fees. That's the second line from the bottom, where you'll see in 2010 it sat at 4.4%, currently at 0.8%, and that's mainly due to the internalization of property management. This is once again for the academics. This is a statement of financial position. The two middle columns are the columns to focus on. What we've done here is we've included on the two outer columns the published numbers. The 2012 group has Redefine International consolidated, and it has Cromwell equity accounted. And the 2013 group has Cromwell treated as an investment, Redefine International deconsolidated, but Fountainhead consolidated. So very confusing and almost impossible to make sense of. But if you look at the middle two columns, that's what Redefine's management is charged with. And once again, if there are any questions, happy to answer them. I just want to draw your attention to the non-current assets held for sale and similarly the non-current liabilities for sale. There are substantial numbers in both those two lines, and they're made up in the assets case, mainly the 2.2 billion property portfolio that we're wanting to list next year, the government office tenant portfolio, and about 2 billion rand of Hyprop. And then there's debt of about 1.8 billion rand in the 2 billion rand below that in respect of expensive debt that we're going to be restructuring as part of the office portfolio. Looking then just at our listed securities, once again, they're all over the place in the balance sheet. I've just provided a map here back to the balance sheet to give you a point as to where they're located. As you can see, Cromwell and Arrowhead, it's a very small investment in Arrowhead that we've got, sits under listed securities. As a subsidiary, we've got Fountainhead. Now, you'll see the market value of Fountainhead is 4.3 billion rand. This was as at 31 August. But what has been consolidated from a net asset point of view is just under 4.1 billion rand. Redefine International is treated as an associate, 2.3 billion rand from a market value point of view. However, if we equity account it, we're only putting 1.7 billion rand onto the balance sheet. Hyprop is a held for sale asset. We've spoken about that. Just looking at our funding, the reason why I've done an analysis of Redefine is because the Fountainhead debt and its assets, given the nature of the PUT vehicle in which those assets and liabilities are located, they are ring-fenced. So from a credit point of view, it serves no purpose to look at group statistics because you can't attach those assets, you can't, the debt isn't of any recourse back to Redefine. So we focus just on the Redefine column there. You'll see our debt, excluding the held for sale debt, is sitting at 12.1 billion rand. As I said earlier, it's up about 2 billion rand on last year. But in terms of key statistics, if you look after excluding the held for sale debt, we're sitting at 37.3% as a loan to value ratio. We have upped our debt capital market funding, as I said earlier. It's now 20% of our debt. We would like to grow it to 30% in time. Having said that, since May, there haven't been many issuances from property companies on the debt capital market. I know Hyprop did one today, a 6-year note, which was quite well priced. So maybe there is still strong appetite out there for debt capital markets, but we will test that in due course. Our percentage of debt is 70% secured, and that's an area of focus for us for next year, with Moody's having alluded to the fact that if we want to get an upward rating, we need to lower that percentage. So we're going to work hard to do that. It's not very easy. Banks don't like lending on an unsecured basis, except one. We'll have to work on the other three. And then in terms of market value of assets secured, you'll see that 22 billion rand of our assets are secured. Now, that provides a huge amount of headroom, given that 22 billion rand actually goes against 70% of, call it, 14 billion rand. In terms of weighted average cost of borrowings, I've already touched on that. Our percentage debt that's fixed is currently 66%. Our target is 65%. As I said earlier, the markets overreacted to the May announcement on quantitative easing. It has come back a bit, but if we look in terms of our indicative pricing since then, the markets have probably gone up about 120 basis points, which has put huge pressure on new acquisitions, given that we need to fix our debt long term. So it's going to take quite some time for the sellers to come to the party in terms of reasonable expectations on yields, given where long-term debt now, new long-term debt, is going to be priced. Undrawn facilities, we've got about 1.8 billion rand of undrawn facilities available on demand at year end. And when we get to the cash flow analysis, you'll see a very small cash position. It's not to say we don't have access to money, it's just we are optimizing our cash levels. And that 1.8 billion there actually keeps me sleeping at night, knowing that we can phone the bank and have money on demand for Mark to do another deal. Our debt maturity profile, it's taken a long time to get to where it is. It's still work in progress. I think we need to fill in a few blocks post-2018 if we can, but certainly maybe 2016 and 17, and this is a hint for the banks to maybe see what they can do there for us, just to get those lines up a little bit and flatten the curve out. And then just to touch on Moody's, did refresh their credit rating. It was unchanged on the 5th of August, and we hope to please them even more this time round, and hopefully in due course we'll be able to score a rating which they will award us. In terms of net asset value, as you can see here, our net asset value grew from 801 cents to 871 cents. And what is a standout achievement here for us is the fair value adjustments of 31.2 cents that's been added to NAV. And that stands to the fact that we now invested in quality assets with sustainable revenue streams underpinning those values. The deconsolidation of Redefine International did assist. It's almost 20 cents. There was a little bit extra from the acquisition of Fountainhead. But in addition to that, the extra capital that we raised overall has been beneficial in that although we've got an extra amount of 58 cents, there has been a dilution as a result of the extra units in issue. Okay, then just looking at the cash flow, the only points I want to make here is you'll see that we optimize our cash flows as best we can. Unproductive cash is something that we're allergic to. You'll see only 40 million rand in Redefine's case at year end. Fountainhead had a bit more. But as you can see, it's a delicate balancing act, trying to get funding equal to investments. From a timing point of view, it's very frustrating in that in a number of instances, from the time that you shake hands on a deal to the time that you actually, apart from getting the lawyers to do the agreements, to actually getting transfer of the property can take between or at least 9 months, and in some cases it's taken us up to 18 months with some engineering to get us through to the 18-month period. So it's very difficult to land the fish once you've caught it. And that's where funding becomes very difficult. We fund the banks up in a panic normally. We need money. They rush to our aid, and unfortunately we can't draw because we're waiting for the asset to transfer. Hopefully, in due course, we'll be able to speed that up, but that is one of our big challenges. Just looking at risks, I think black swan events came about from the GFC. It was a term that was introduced then, but it seems to be becoming the norm now. I think we're becoming quite used to the fact that there is going to be some sort of shock that we've never thought of, and someone will rationalize it to an extent that we would have thought that it's always been something that was there. So risk management for Redefine has taken on a new meaning. What we're trying to do is minimize the impact of the improbable. These risks aren't new to anyone in the property industry. I won't spend too much time on them, but I do think the triggers are areas which are beyond our control, and we can only manage within that space, which does result in quite a bit of volatility at times and does add to our cost base as well. Our unit holder profile hasn't changed much since the previous presentation that we've done. I think State Street is something of interest. That's a US-based custodian holding for a number of US-based funds their shares. As you can see, it's our second largest share. We've got about 23,000 unit holders, and you'll see that the top 10 hold just under 43%. If I just move on to the next slide, from a country point of view, and this is thanks to Mark, he pointed this out this morning, you'll see that from 2008 through to 2013, our international ownership grew about 10 times. But the real story isn't that statement. If you look at what our market cap was back in 2008, that 1.4% was worth 100 million rand, and that 16% now is worth 5 billion rand. So it's not a tenfold growth in terms of value invested in Redefine. And as you can see, the States is our biggest international investor by quite some margin. Just looking at Redefine's returns from a share price point of view, for the 12 months ended August, it was going great until May, until quantitative easing was announced. And then the wheels came off. You'll see we went from a high of about 12 Rand down to a low of about 9 Rand. And that is principally, apart from the movement in the bond yields, which you'll see had a similar trend, Redefine's a very actively traded stock. Our average monthly trade is about 1.1 billion Rand. around 4% of our market cap, and by value of the sector, about 14% of the average monthly trade. So being a highly liquid stock, we felt the brunt first as a result of the change in sentiment brought on by Bernanke's announcement. It has recovered somewhat. Our share price is around 10.40 Rand tonight. So had we have carried on the slide until this morning or this evening, there would have been a little bit more red on the upside there, but nonetheless, certainly well below the high of 12 Rand. But I tried to do here, and Evan Jankelowitz is in the room here somewhere. We believe that Redefine as an investment is more like an inflation-linked bond, in that you've got a capital underpin, which appreciates approximately 6% over the long term per annum. And on top of that, you have an income return of about, call it 6 to 7% per annum in growth terms. That gives you, over the long term, 13 to 14% as a total return. So Mark came to me and said, let's try and graph our performance, not against the R186, which is just a normal government bond, which we track quite reasonably until recent times. You'll see there's a bit of a departure there, but up until then, it's been pretty close. But the inflation-linked bonds don't actually, until recently, since May, seem to suddenly have come into the picture. The main reason, I think, could be because of liquidity in those bonds. I chose these two bonds because they seem to have been the two most traded, given the volumes that I could see, or the values traded. But nonetheless, it's there for academic interest. And then just looking at Redefine on a standalone basis. Our net asset value, as I said earlier, was 8.71 Rand. But if I take the listed securities NAV within our IFRS balance sheet and exclude them, I get to Redefine share of the net asset value, and that's 5.37 Rand. If I compare that to the market value or the linked unit price for the group at 9.16 Rand on the 31st of August, and once again split out the listed securities that are priced at the same date, you'll see that Redefine is priced at 5.51 Rand. That's a premium of about 103 times. That was at August, I admit. And that, if you roll it onto the 25th of October on the same basis, is at about 1.2 times. If you do it today, it's probably still close to the 1.2 times range, given that all the other counters have similarly moved up. If I now introduce the distribution per linked unit, and I exclude the contribution from the listed securities, you'll see that Redefine contributes 47.9 cents to our overall distribution. And if I once again work that back into the net asset value of 5.37 Rand, you'll see a historic return on the net asset value of just under 9% for 2013. And if I base it on the market values at August and October respectively, you'll see 8.7% and 7.7% respectively. Once again, if I drill down and I do it tonight, at close of play, it's probably closer to 7.5%, thereabouts percent. And in our view, Redefine on a standalone basis still holds some value. In our view, we feel that it does merit some uptick in terms of pricing. In terms of total return, I could not do this analysis with share prices, given that the August price wasn't great. So I went back to the growth in the net asset value of 69.3 cents, and I added to that the full distribution for 2013. That gives you a capital and income return of 138 cents, which in percentage terms relative to the net asset value of 2012 is a 17% return. So that's a book return. It's not necessarily an investment return. And the message here for me is that the fundamentals within Redefine are absolutely intact, and they do support a decent share price. Not currently the case, but we hope in due course that we will be able to convince the investment community that we warrant a re-rating. With that, I'm going to hand you back to Mark.
Thanks, Andrew. As always, very detailed, and for someone like me, somewhat confusing, but I'm sure that some of the academics are going to have a lot of fun, and especially in the one-on-ones, be picking some of that apart. As I said, reasonably happy with what we've achieved with Redefine. So what does the future hold? I think the subdued trading environment continues. I don't think the NDP or any of the other initiatives are going to make that much different. Rates and taxes is a challenge for us. We currently have 70 properties where the rates increases are ranging from in excess of 10 to up to 30%. Obviously, we're fighting with the local authorities, but that's an issue for us. Financial markets will continue to have volatility, but nevertheless, we're well focused to manage the various and the variables within that. I think what's happened over the last 2 to 3 years is Redefine has become a very defensive stock. I don't want to say boring, but you know, if you think about your own personal investment portfolio, so if you had a couple of $1 million or whatever your investment philosophy was, and you put it all into cash, a safe haven, you're not going to do too well. And if you put it all into sort of medium risk kind of stuff, and we did have a black swan or a disaster, you're at risk of losing all of it. So the kind of approach we take is say, let's pick a number, 90% of our portfolio, which we'd really like to be nice, rock solid. And then the 10% is going to be where we use some flair and opportunity, and I'm not saying those are the exact percentages, but I'm trying to illustrate. So we're always going to have some kind of entrepreneurial and higher risk kind of element, which will give us some juice. We are going to continue to improve the portfolio without diluting income substantially. As I said, we hopefully dispose of that government office portfolio, which will be a big milestone for me. And we've already got the 3.4 billion under our belt. There are a couple of other nice negotiations on the way. So that should all go well. So we look at it and we look at our budgets and we say, next year we're pretty comfortable that we will achieve a similar result to this year. That's where we are. From a personal point of view, I would like to do a little bit better, but we're not promising that. Just from Dr. Richard Maponya's point of view, I'd just like to explain one thing to you. Redefine can't always compete on price, and when you put your property out or your shareholders put it out, we knew that the pricing would be competitive, but yet you had given a range, that you had the choice of who your partner would be, because your partners would accept a little more or a little less. And that's why we came to visit you, because we couldn't go any higher, but we knew if we meet somebody face to face, and you can put a face to a name, it's a little bit harder than to say no than if you're just looking at a name on a piece of paper. So I disclosed that today, but notwithstanding that, we did want to meet you and we look forward to partnering you. But these are the kind of things we try and do at Redefine, and I hope that was one of the reasons that it worked for us, because we can't always write the biggest check. Thank you.